Thank you for joining us for another edition of the Market Commentators podcast. My name is Andy Willms, President and CEO of the Milwaukee Company, and joining me this morning once again is Mike Willms, who is our Chief Compliance Officer and Chief Operating Officer. Good morning, Mike.
Good morning, Andy. Good morning, everyone.
Just a quick reminder that nothing in this podcast should be construed as investment advice, and that all views expressed represent Mike and my personal views and not those of the Milwaukee Company. And Mike, I will gladly point to my display of my team colors here. I know you're not a baseball fan, but I certainly am. And the Brewers start their 3-game series with the Dodgers tonight in LA. Dodgers had the best record in baseball, and the Brewers were the last team to get in. They had the worst record of the teams that made it to the playoffs. They were under 500, as a matter of fact. But that's all behind us now, and seeing as was the Dodgers who beat the Brewers in the National League Championship a couple of years back, we have a big chip on our shoulder for them, and time for a little revenge. So big day for us Brewer fans.
Well, trust me, I'll be pulling for the Brewers. So
I'm glad to hear it. Thank you. Appreciate it. Okay, so let's get started with a recap of what happened in the markets. 1 point last week, the Dow was up by more than 3%, and was down by more than 3%, and the S&P was down by about 2%, as concerns grew about the potential for a second wave of coronavirus cases and lingering uncertainty about a new round of stimulus and lofty stock prices, especially with regard to the mega cap tech stocks that we all know have been doing exceedingly well for most of this recovery. However, a late surge in those same tech stocks lifted both indexes from their lows of the week and helped the NASDAQ to actually snap a 3-week slide. The Dow and the S&P still finished in the red, with the Dow down almost 2% and the S&P logging just over a 0.5% decline. International markets were even worse, suffered even worse. They were down about 3%. Emerging markets were down actually about 3.5%. And bonds were really of little help last week, as corporates were down about 1.5 points, while treasuries were basically flat. I mean, I think they had, a 0.3% gain, something like that. So it was a tough week last week, in most accounts, but the Dow and S&P and the NASDAQ all started off this week on a good note. On Monday, the Dow was up 400 plus points for a 1.5% rise at the end of trading, and the S&P gained about 1.5%, and the NASDAQ was up almost 2%. But we reversed course a little bit yesterday. Basically just the markets, each of the indexes were down between 1/3 and 0.5%. And the primary driver of that was probably New York City's reporting that it had a daily rate of COVID tests top 3% for the first time in months, which was enough to raise serious concerns in New York about schools and restaurants and that sort of thing. But, pales in comparison to what we have here in Wisconsin, where yesterday they announced that the positive rate was up to 22%. And so I can only imagine how that would be handled in New York. But certainly there's a lot to be concerned about on the COVID front, and I'm hoping you can update us on some of the things you've been following in that regard.
Okay, well, before we touch on the COVID, I would point out, going back to your comments about the fixed income markets, there is kind of a market signal if treasuries are moving higher and or at least not tracking lower along with other fixed income alternatives. If the corporate market was down 1.5% versus the treasury market being up just slightly, that would mean spreads are widening here, and that normally is a signal on an increase in risk levels.
Okay. Yeah, because obviously the corporates don't have the security that a treasury does, so people are more of a flight to safety.
People are wanting to get paid a little bit more yield-wise to assume the risk of not having that government guarantee for repayment, and So, I mean, that's always kind of, keeping an eye on spreads is always a prudent thing to do. So, in regard to the COVID situation, worldwide, the number of cases are now exceeding 7 million. There have been 1 million recorded deaths. These are kind of grim statistics here. I wish I wasn't needing to share those kind of numbers, but you're seeing infection rates increase in the UK, in Denmark, and some of the other European countries, with Spain having new record cases. And in the UK, Prime Minister Boris Johnson said the country is in a perilous turning point, and they're re-examining lockdowns and reinstituting some of the more severe social distancing, business closing type policies that had been reversed earlier. On an interesting positive note, Finland has begun offering tests at the Helsinki airport with trained dogs that are actually capable of sniffing out the virus at a very high 94% success rate, with just a short 10 second sniff, which is really pretty amazing. There has been the use of dogs in identifying people with different diseases for some period of time, and the interesting part is the dogs are actually in a position to determine asymptomatic infections, as well as people demonstrating symptoms. Yale has designated 3 independent laboratories to perform their saliva direct COVID-19 test, and the saliva direct will be available in Florida, Minnesota, and New York by sometime, well, hopefully by today, because it is late September. So,
and that test, it's very, very quick. That's the beauty of it, right? I mean, this is the test
exactly.
This is the test they developed for the NBA, and the NBA really drove this development of this test so that they could continue the NBA season. And now it's the fastest, other than the dogs, which I think are very promising, actually, because it'd be a simple way to get people back on airplanes. But the saliva direct test is really, if we can get that available throughout the country, it will be a really good way to test people. And once you have testing, then you can have, I think, really get a clamp on down on this. So. Well,
and I guess the fact that it is as simple and the response is almost, well, it is immediate. The only issue is with the CDC trying to monitor infection rates. It almost gets to be like a pregnancy test kit, where you can do it at home,
right?
And isn't an actual tracking of the infection rates, but it's utility and speed and ease of use. I mean, that's fabulous. And we had previously discussed the collaboration between the NBA and Yale and how this all allowed them to continue with the NBA season. It's really pretty amazing.
Sure. And the debate last night was pretty amazing too. Did you have wherewithal to watch it? I mean, oftentimes I should say, oftentimes elections are, their impact on the markets is overstated. People think they're going to have a really big impact, and then ultimately they don't. But I think this year's outcome has the potential to affect the markets much more than most. And we see that concern with this spike in options trading on investors who are trying to hedge not only the election, but for the weeks after, because there's real concern about, and I think at this point getting to be more legitimate concern, that the outcome won't be known for weeks or months, and the transition of power could be interfered with, or could not go as smoothly as delayed at least. Yeah, and like it was when Al Gore, contested the election and ended up in the Supreme Court. We could see something like that again. So that could have an effect on markets. And and by all accounts, I think the last night's debate was disappointing for investors and downright disheartening for many of us, who, especially those who were undecided about who they were going to vote for going into this. I don't know if many undecided voters found something that would make them rally behind one of the other two candidates. So, what do you think is going to be the market's play on all of this?
Well, I mean, first of all, I agree with you. I mean, it was disheartening. It was hard to watch. I mean, with the interruptions, nobody really made any kind of decision-changing statements about policy or how they would conduct themselves in office. I think there's been so much debate about the potential effect of either party winning an election. It was kind of a surprise with the response by the market when President Trump was elected initially in 2016. That was the first time that there really truly was a large market reaction going back the last 5 or 6 presidential elections. My expectations would be that there would be a concern if the Democrats ended up with control of the Senate and Biden became president, with increased levels of regulation and the potential for a tax increase to fund some of the stimulus spending. And I think if we actually have an agreement between the White House and the Democrats relative to an additional stimulus package prior to the election, it's probably not going to include the state and local government assistance that the Democrats are advocating for. So if there's a control in the Senate and Biden's president, I think that you'd see some additional spending that the GOP does not necessarily agree to. And the market just doesn't like taxes.
Yeah, well, that's for sure. It tends to be a drag on stock. Taxes tend to be a negative and have a negative impact on stock market performance. But I found it interesting that on Monday we had a work and school professor, Jeremy Siegel, who is nobody's dummy. I mean, he's a smart, very smart guy and a good, very highly regarded market observer, say that he thinks the stock market could enjoy strong gains regardless of whether Trump or Biden occupy the White House. He pointed to the same sort of things that you're mentioning. He said there's 3 primary forces that he identified that could drive the stock market higher. It was the increased money supply as a result of the coronavirus stimulus efforts. I mean, that increase in money supply has certainly had a major impact on what the market has done so far, because this money's ultimately got to find a place to go. And so if we do have another round of stimulus package, that'll be good for stocks. He pointed to the prospect of an improved COVID-19 situation with the improvements in testing that we've talked about. We've had improvements in testing, we have improvements in treatment, and we have great hopes for a vaccine in the near future. So that would all be positive for the market. And you see this ongoing increase in growth in worker productivity brought on by technology. Now, all that being said, there are also compelling reasons why what happens next could be negative. Like you said, if depending on how the election turns out, it could end up having a very negative impact on markets. You got, the new governmental policies and regulations, which could create a burden on business. You have the potential for a worsening of the virus combined with a Biden win could lead to another shutdown of the economy. I think one thing that candidate Biden made clear last night is that he's not beyond another shutdown. I mean, if he thinks that is necessary to control the virus, he would do it. I think President Trump is of the mind that at this point we have enough treatment method and made enough progress on treatment and testing that another shutdown should not be needed under virtually any conceivable circumstance. And you have the expanded deficit spending and higher taxes in store if the Democrats sweep both the presidency and both houses of Congress. So you put that all together, and what is an investor supposed to do? I mean, it's probably too late to try and go out and hedge it through options. I mean, that market's been pretty well, that horse is pretty much out of the barn. But I think really it depends on what my personal view is, it depends on what your risk level is and your investment horizon. If you're generally, I would say investors should consider rebalancing their portfolios if the drift in the stock market, the uprise in the stock market has resulted in there being a greater allocation to equities than they normally would have. And that may be sufficient. I think, for many investors, that'll be sufficient, simply rebalancing your portfolios back to their original target weights. But if you're an investor whose primary objective is wealth preservation as compared to wealth creation, then you may want to go further and adopt a more defensive stance, I think, for the rest of 2020. And perhaps even beyond 2020, if an unusually high degree of certainty remains when the year comes to a close. So, but one thing I probably would not do is make a major bet on what the outcome will do and try and position my portfolio for a winner-take-all type strategy. My guy wins and I do great. I mean, we've seen many, many instances of where that's backfired in even the most astute and successful investors. Anyway, enough about politics. Let's talk about something away from politics for the time we have left. And, one of the things is we should probably talk about is how the pandemic is affecting the economy and maybe in ways that people aren't paying as much attention to as they normally would because there's so much to distract your attention at this point. Do you have ideas in that regard, Mike?
Well, I guess it all kind of ties in. We can't really get away from the political arena completely. With the stimulus spending to this point, it has, with the CARES Act and the high level of support that's been provided to the economy. It goes back to your comments with Dr. Siegel's observations about the Federal Reserve and support that they're providing. There is $1 trillion worth of excess savings that have gone into the banks through the stimulus programs. And that will provide additional ability for the bank support. We still had an incredible level of bankruptcies year to date. It was the highest level of store closings and bankruptcies filed in there's been over 10,000 store locations that have permanently closed. 16,000 restaurants, independent restaurants, the first half of the year. There's the potential of up to 25,000 store locations closing with major retailers. I mean, names that we've known all of our adult lives, Neiman Marcus, JCPenney, Pier 1, filing in the first half. And additional stores. I mean, I had bought a number of business suits, which you don't need a business suit right these days, from Brooks Brothers, for instance, and they filed for bankruptcy here subsequent to July 1st. So you've got that side of the equation. The interesting part is that the St. Louis Fed tracks new business formations, and the second quarter had the highest level of new business formations, 883,000 and change. So, I mean, the entrepreneurial spirit is alive and well here in the U.S., and where there's an opportunity, people are still trying to provide, take advantage of the vacuum that's been created with some of the economic changes around the virus.
Well, that's very interesting, because I would have thought that Sears Roebuck's bankruptcy would have affected your wardrobe more than Brooks Brothers. but be that as it may, you're right about this. The whole
do they sell Carhartts at Sears, or is that? I think you got to go to Fleet Farm for Carhartt.
Yeah, you do. All that legitimate concerns about this skyrocketing bankruptcy, and the fact that many of the jobs that have lost as a result of the bankruptcy are going to be hard to replace. The news is not all bad. In fact, the housing market is in a boom right now. It's the hottest pandemic purchase is a new house, and many more Americans are taking advantage of these low mortgage rate. So, they're kind of trading elevators and cramped quarters for yards and more spacious at-home work environments, And some of and housing has a huge impact on the economy. There's no doubt about it. It's a leading and arguably even dominant force in the business cycle. In fact, some have suggested housing is the business cycle. So there's this notion that the housing market can save the economy almost single-handedly, and that the growth and demand for housing will be enough to keep the economy from going into another Great Recession, which could happen. I mean, it's possible. I mean, new construction and sales of homes unleashes a whole wide range of economic activity and purchases of home furnishings and building materials, and that all has far-reaching effect. And the market's certainly been on a tear. I mean, home prices jumped by 2% in May, between May and July, which is the greatest jump in 30 years of record keeping. And sale of existing homes sold to a 14-year high in August, and new home supplies are up, but are being constrained by supply. So all of that says, hey, maybe the housing market is going to keep our feet from the fire. But there are threats circling to the housing market too, don't you think?
Well, yes, and I think the repeated observation I'd make here, we talked in one of the previous podcasts about just exactly what the Federal Reserve is purchasing, and in addition to the $80 billion a month that they're buying of treasuries, they're also buying $100 billion in mortgage-backed securities, and thereby driving interest rates on mortgages lower. In fact, I'm personally, I'm trying to refinance mortgage and would save 125 basis points, which, I mean, if you start out at a 4% interest rate and end up at 2 3/4, that if you're buying your first time home, or if you're upgrading, your occupancy cost is materially affected by that kind of change in interest rate and what your monthly payment would be. Yeah. So, the Federal Reserve has got a lot to do with what's happened with the housing market by lowering interest rates through their mortgage-backed security purchases.
Absolutely. It's a major factor. All right. Well, I think we got time for just a very brief discussion on the last topic I had identified for today, and that is the sudden popularity of gold. With some of the most major investment advisors, both UPS and Wells Fargo now have gone on record by saying that gold is a very good hedge to use their terms, over the U.S. Over the uncertainty caused by the U.S. election and the COVID-19 pandemic. And, I just wanted to comment a little bit about that, because it's true that low interest rates and a weakening dollar could make gold a good hedge, right? I mean, but gold's track record as a hedge against the bear markets is mixed at best. And really, if you're going to own gold, are you going to own it physical gold? I mean, that creates its own problems. Are you going to buy shares in a mining company, or you're going to buy an ETF that holds physical gold for you? Well, I suppose you could, but now you're relying on that organization to be able to produce the gold if you ever want it. So, and the problem I've always had, I've never been much of a gold bug, and the problem that I've always had with it as an investment is it has no intrinsic value, or very little. I shouldn't say no. Its intrinsic value is largely gone, other than as in jewelry and that sort of thing. And it generates no income unless you sell it. So that's problematic too, because in order, if you're going to own gold, you are by definition going to be a market timer, because you're planning to sell it to generate all of your profits. So in short, yes, I think gold can be a good hedge, but I also think there are better alternatives, which we've talked about in the past, and which I write about in some of my prior newsletter article columns. So anything you'd like to add to that, Mike, that thinking?
Well, I mean, I think the first observation I would make is to have two major investment banks suggest gold as a hedging alternative. A lot of that has to do with the interest rate environment that we're in. To your point, gold does not have a yield. The only way that you profit owning gold is to buy it at a lower price than where you sell it. And your opportunity cost owning gold is much less, with a 10-year treasury at 66 basis points versus 5%. So that's got a lot to do with recommendations. And it's all a matter of how you look at the value of gold itself. And if you go back to the Spanish and the Aztecs just had gold and silver as artistic pieces and didn't actually use it as money. So right. I mean, if perceptions change, you just never know what's going to happen.
Well, I'm amazed you remember that far back. Back in, those are really your earlier days, but I'm glad you could draw those personal experiences to inform our discussion today.
I'm not that much older than you.
And that happy note, we'll wrap it up. Thank you all for joining us today. Please keep in mind that you should not act on anything that you've heard in this podcast until you've discussed it with a qualified personal investment advisor who's familiar with your own personal situation and your own personal investment objectives. And with that, I'll say thank you Mike for joining me this morning. It's been fun. And all our viewers, I'll thank you as well, and wish you all a great day.
Have a great day, everyone. Thank you.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.